There's a subsidy cliff nobody warns retirees about, and it can cost you thousands of dollars in a single year, triggered by something as small as one extra Roth conversion, one unusually large capital gain, or one required distribution that happened to land at the wrong time. Here's what no one tells you. Medicare Part B and Part D aren't flat rate costs for everyone. What you pay is based on your income from 2 years earlier through a system called IRMAA, the Income-Related Monthly Adjustment Amount. And unlike a normal tax bracket where crossing a line by $1 only affects that $1, IRMAA works differently. Cross a threshold by even a single dollar, and your entire premium jumps to the next tier for the whole year for both you and your spouse if you file jointly. That's the cliff, not a gradual slope. A cliff. Let's make this concrete because the abstract version doesn't capture how sharp this actually is. Imagine a retired couple with a combined income just $1 above a specific threshold. That $1 can push their combined Medicare premiums up by hundreds of dollars per month for both spouses for the entire year. Not because they suddenly earned meaningfully more, because they crossed an invisible line the system doesn't warn you about until the bill arrives. Here's why this catches so many people off guard. The income used to calculate your premium isn't your income this year. It's your income from 2 years ago, based on your tax return from that year. So a Roth conversion you did 2 years ago, or a large capital gain from selling an investment, or a one-time distribution to cover an unexpected expense can trigger a Medicare surcharge that shows up long after you've forgotten about the transaction that caused it. This is the trap. Financial decisions and their consequences are separated by a 2-year gap, which means most retirees never connect the dots between the cause and the surcharge until it's too late to undo. Let's talk about Bill and Susan one more time, because this exact situation happened to them. In the same year they were converting a portion of their traditional IRA into a Roth, using their low income window, as we discussed, they didn't realize the conversion amount, combined with their other income that year, would push their reported income 2 years later just over an IRMAA threshold. 2 years after the conversion, their Medicare premiums increased noticeably for both of them for the full year. They hadn't spent more, they hadn't changed their lifestyle. A single financial decision made without checking the specific threshold created a cost that arrived on a delay, disconnected from the original transaction. This is exactly why Roth conversions need to be planned with IRMAA thresholds in mind, not just tax brackets. The two systems don't move together. You can be comfortably inside a favorable tax bracket and still trigger a Medicare surcharge because the income thresholds for IRMAA don't align neatly with standard tax bracket lines. So, how do you actually avoid this cliff? First, understand that IRMAA has several tiers, each with its own income threshold for individuals and for married couples filing jointly. These thresholds adjust slightly most years for inflation, so the specific dollar amount isn't something to memorize once and forget. It needs to be checked against the current year's published figures before making any large financial move. Second, understand what counts as income for this calculation. It's not just your paycheck or pension. It includes Roth conversion amounts, capital gains from selling investments, required minimum distributions, and even municipal bond interest, which is normally tax-free, but still counts toward this specific threshold. This surprises a lot of people because they assume tax-free income can't affect a cost calculation. For IRMAA purposes, it can. Third, understand the 2-year lookback. Any large financial decision this year affects your Medicare premiums 2 years from now, not immediately. This delay is exactly why so many retirees get blindsided. The connection between cause and effect isn't visible in real time. Here's the practical roadmap for avoiding this cliff. Step 1. Before making any large financial move, a Roth conversion, selling a large investment position, or taking an unusually large distribution, check the current year's IRMAA thresholds for your filing status. These are published and updated by Medicare each year. Step 2, calculate your projected income for the year, including all the income sources that count toward this calculation, not just your typical taxable income. Step 3, if you're close to a threshold, consider whether the financial move can be split across 2 years instead of 1, keeping each year's income below the line rather than triggering the surcharge in a single year. Step 4, if crossing the threshold is unavoidable or the underlying financial benefit outweighs the surcharge, at least go into the decision with full awareness of the cost rather than being surprised by it 2 years later. Step 5, if your income 2 years ago was affected by a one-time event, a large one-time capital gain, a legal settlement, or a similar unusual circumstance, know that Medicare allows you to file what's called a life-changing event appeal, which can adjust your premium based on more current, accurate income if your circumstances have genuinely changed since that look-back year. That last point matters more than people realize. A lot of retirees assume the IRMAA surcharge is fixed and unappealable once it's triggered. It isn't in certain circumstances. If your income has dropped since the look-back year due to retirement itself, the loss of a spouse, or another qualifying life event, you can request a reconsideration using a specific Social Security form and provide documentation of your current lower income. This won't apply to every situation, particularly a one-time Roth conversion you chose to make voluntarily, but it's worth knowing this option exists for genuine changes in circumstance. Let's also address why this matters so much for the specific transition happening around age 65. This is precisely the moment many retirees start layering multiple income decisions at once, deciding when to file for Social Security, whether to convert retirement accounts, and how to structure withdrawals, all while transitioning onto Medicare for the first time. Each of these decisions, made in isolation, might look reasonable. Made together, without checking how they interact with IRMAA thresholds, they can compound into a surcharge that catches people completely off guard. This is why the smartest approach isn't just optimizing your taxes or optimizing your Social Security filing age in isolation. It's looking at the full picture together, because a decision that saves you money in one area can quietly cost you money in another if the two systems aren't checked against each other before you act. One final thought before the recap. This entire topic tends to feel overwhelming the first time someone hears it because it sounds like there's a hidden trap waiting behind every financial decision in retirement. That's not quite the right way to see it. There's one specific mechanism, the 2-year look-back tied to specific thresholds, and once you understand that single mechanism, you can check almost any decision against it in a few minutes. This isn't about becoming a tax expert. It's about knowing this one system exists and remembering to check it before, not after, a large financial move. Here's the recap. Medicare premiums for Part B and Part D aren't flat. They're based on your income from 2 years earlier, and crossing a specific threshold, even by a single dollar, can push your entire premium into a higher tier for the full year for both spouses. This is the subsidy cliff. It's triggered by Roth conversions, capital gains, required distributions, and even normally tax-free municipal bond interest. And because of the 2-year look-back, the cause and the cost are separated by enough time that most people never connect them until the bill arrives. Before you make any large financial decision in retirement, a conversion, a big sale, an unusual distribution, check where that decision puts your income relative to the current year's IRMAA thresholds. A small adjustment, splitting a transaction across 2 years instead of 1, can be the difference between staying just under the cliff or falling over it, for reasons that won't show up until 2 years later. Let's go a little deeper on the tier structure itself, because understanding the shape of it helps you see why small decisions carry such outsized weight. Medicare typically publishes several tiers above the standard premium. The first tier above standard might add a modest surcharge. The next tier up adds more. Each subsequent tier adds progressively more until the highest tier, reserved for the highest earners, can push the combined Part B and Part D premium to several times the standard amount per person per year. For a married couple, that's not one surcharge, it's two, since Medicare premiums are assessed per individual even when household income is calculated jointly. This is why couples get hit particularly hard by this cliff. A single threshold crossing doesn't just raise one premium. If both spouses are enrolled in Medicare, it raises both simultaneously because the same household income figure gets applied to each spouse's individual premium calculation. Let's walk through a second example because this pattern shows up differently depending on the household's specific situation. A retired small business owner sold a portion of a rental property 2 years before turning 65. At the time, the sale felt like ordinary financial housekeeping, simplifying his holdings before fully retiring. He wasn't thinking about Medicare at all, since he wasn't yet eligible and had years before that conversation would matter. But because of the 2-year look-back rule, that capital gain became the exact income figure used to calculate his Medicare premium the year he turned 65. He walked into his Medicare enrollment expecting the standard premium everyone talks about, and instead found himself in one of the higher surcharge tiers, entirely because of a transaction he'd made years before he ever thought about Medicare specifically. This example matters because it shows the look back isn't just a retirement planning issue. It's relevant even before you're close to Medicare age if you're planning any large financial transaction within the 2 years before you turn 65. The look-back window starts counting before you're even eligible, which means the planning window for avoiding this cliff actually opens earlier than most people assume. Now let's talk through the appeal process in more detail, because knowing it exists isn't the same as knowing how to use it. The specific form is called Form SSA 44, and it's used to request a reconsideration of your income-related monthly adjustment amount based on a qualifying life-changing event. The qualifying events include things like retirement or reduction in work hours, marriage, divorce, or the death of a spouse, loss of pension income, and a few other specific categories defined by Social Security. Here's the important nuance. A voluntary Roth conversion made simply as a tax strategy generally does not qualify as a life-changing event on its own. This appeal process is designed for genuine changes in your ongoing income, not for one-time strategic financial moves you chose to make. This distinction trips people up. They assume any drop in income qualifies for reconsideration, when in fact, the form is specifically built around a defined list of circumstances, mostly centered on things that happened to you, like retirement itself or the loss of a spouse, rather than things you proactively decided to do. This is exactly why planning ahead matters more than appealing after the fact. It's far more effective to avoid triggering the surcharge in the first place than to hope you can undo it later. The appeal exists as a safety net for genuine life changes, not as an undo button for voluntary financial strategy. If you do experience one of the qualifying life-changing events, here's what the process generally involves. You'll submit Form SSA 44 along with documentation supporting the change, a retirement letter from an employer, a death certificate, divorce documentation, or similar proof depending on your specific situation. Social Security then reviews your case using more current income information rather than the 2-year-old look-back figure and adjusts your premium tier accordingly if you qualify. This typically takes time to process, so submit it as soon as the qualifying event occurs, rather than waiting until the higher premium has already been charged for months. One final thought before the recap. This entire topic tends to feel overwhelming the first time someone hears it, because it sounds like there's a hidden trap waiting behind every financial decision in retirement. That's not quite the right way to see it. There's one specific mechanism, the 2-year income lookback, tied to specific thresholds, and once you understand that single mechanism, you can check almost any decision against it in a few minutes. This isn't about becoming a tax expert. It's about knowing this one system exists and remembering to check it before, not after, a large financial move. Here's the recap. Medicare premiums for Part B and Part D aren't flat. They're based on your income from 2 years earlier. And crossing a specific threshold, even by a single dollar, can push your entire premium into a higher tier for the full year for both spouses. This is the subsidy cliff. It's triggered by Roth conversions, capital gains, required distributions, and even normally tax-free municipal bond interest. And because of the 2-year look-back, the cause and the cost are separated by enough time that most people never connect them until the bill arrives. Before you make any large financial decision in retirement, a conversion, a big sale, an unusual distribution, check where that decision puts your income relative to the current year's IRMAA thresholds. A small adjustment, splitting a transaction across 2 years instead of 1, can be the difference between staying just under the cliff or falling over it for reasons that won't show up until 2 years later. If you've already crossed this cliff without realizing it, there's a path to potentially reduce the impact, specifically if your income has genuinely changed since the look-back year, rather than simply being the result of a voluntary strategy you chose to pursue. Knowing the difference between the two saves you from filing a form that was never going to succeed and points you instead toward the planning conversation that actually prevents the problem in the first place. But there's a group of retirees for whom this entire conversation gets even more complicated because they're running these calculations with no second income, no second set of eyes, and no partner to catch a mistake before it becomes permanent. If you're navigating retirement on your own, whether by choice or circumstance, the standard playbook most people follow was never built with you in mind. We're covering exactly which pieces of that playbook are missing and how to rebuild them for a retirement of one next.